Good afternoon. We will start the webinar momentarily. Good afternoon and welcome to Gray, and Gray's webinar titled The Top 5 Tax Considerations for McDonald's Owner-Operators. I'm Mark Keshkagan and I'm one of the partners who manages our firm's McDonald's practice group. We are very pleased to have so many McDonald's owner-operators from around the country with us today. Hopefully in your area it's not snowing like it is here in Boston today. One of 3 storms in the last 10 days. I think we're probably three-day storm total. Probably up over 25 inches. Anyway, we appreciate all of you for taking the time for this important presentation. Before we begin, I'd like to give you a little background about Gray, and our long-standing relationship with McDonald's franchisees. We've been working with owner-operators for over 50 years and have developed a very specialized and dedicated McDonald's practice group. We provide all the services you'd normally expect from a CPA firm, including accounting and tax work, but we go well beyond the numbers with our McDonald's clients to include all the financial analysis and reporting that is specific to McDonald's owner-operators, as well as education like we're doing today on many topics as they relate to your business. As a result, we've become the leaders in accounting services for McDonald's franchisees across the country, working with dozens of owner-operators on everything from business planning to rebuild and reinvestment strategies to personal financial planning and the like. McDonald's is a vital core to our business, and we have become just as vital as a trusted advisor to our clients. If you have any questions about Gray, or our services, I hope that you will call after today's webinar. I'd be happy to talk with you. Okay, now on to today's topic, top 5 tax considerations for McDonald's owner-operators. One technical point before we begin. You will see on your screen, I believe, an orange arrow, and you'll also see a hand. If you have a question during the presentation, please press the raise your hand button and field the question, and I will either take it right away or a little later in the presentation, whichever is most appropriate. So the top 5 tax considerations, and the reason why we're doing this today is that it has not, 415 has not arrived. So there is, believe it or not, still time to make some changes to your tax situation if, in fact, you haven't already filed your business or personal tax return. So I want to talk to you about what we consider the top 5. Number 1, more so than anything else, is tax planning. I hope, during every single one of our webinars that we've been doing, our series of webinars that started in, I believe, January and will continue through worldwide, and then also throughout the rest of the year, each one of these focuses on planning, and the importance of planning, whether it's business planning, retirement planning, next-gen planning, reinvestment planning, or even tax planning. These are all so important and so much part of a grander scheme. But when we talk about tax planning, I hope that your tax planning doesn't happen on April 15th when you receive your tax returns from your CPA or tax advisor saying that you owe a certain amount of money. I'm hoping at a minimum that you've had a discussion sometime in December with your tax advisors regarding your tax situation. But more importantly, I hope that you're having an ongoing dialogue throughout the year, whether or not you have a major reinvestment project, a rebuild, MRP, whether or not you've had discussions regarding depreciation, how aggressive should we be, should we accelerate, shouldn't we accelerate. These are all so important, but this is the type of planning that needs to take place all year long. Forecasting future tax liabilities. You shouldn't be surprised at April 15th if you owe money or you're getting a refund. That, at least as part of the all-year planning, should be communicated to you so that you have the ability to plan. Reinvestment decisions, also very much an important part of tax planning. Whether or not it makes sense to do an MRP, what the tax benefit will be from the depreciation that you'll get on a major reinvestment project, and whether or not it makes sense to do it in 13, in 14, in 2012. All very important in tax planning. Maintaining financial viability, another very important area. Believe it or not, when you distribute cash or you take a draw from your business to pay your federal estimates, those get charged to your draw. As you make tax payments, you increase your draw. By increasing your draw, you obviously can affect your financial viability in a negative way. Increased draw certainly can affect cash flow coverage in a negative way. We're going to talk about that in future slides, but also remember that tax planning is vitally important for forecasting future liabilities, maintaining financial viability, and making the reinvestment decisions that make sense in your business. Other outside factors, and in a lot of times, McDonald's owner-operators may own real estate, may have rental income from real estate. They may own McDonald's stock. They may have other portfolios. It's very important that your tax advisor and your CPA be in tune with what's going on outside of the McDonald's business, whether or not you have gains and losses in some of your portfolios, and how your real estate businesses are doing, or any other types of other investments you have that generate income or loss. Very important that your tax advisor understands those other factors. Depreciation, probably one of the most important things when we talk about tax planning, especially in your business, where McDonald's is in a very capital-intensive reinvestment time right now for the business. Depreciation becomes very important. Depreciation planning is very important. So I want to talk to you a little bit about accelerated depreciation. Accelerated depreciation is offered to us in many ways through what we call the modified method of depreciation. It's called MACRS, MACRS, but we also have bonus depreciation in Section 179. I'm sure those are terms that you've heard before. The important thing to note here is that when we talk about accelerated depreciation, it's a timing difference. So what that basically means is you either take it this year or you take it equally over the next 5, or you spread it out different ways. But you're going to get the same deduction, but it's all timed onto what year you'll receive the depreciation itself. So let's talk a little bit about accelerated depreciation. As we know it today, bonus depreciation in 2013 was 50%. This year, 2014, it's gone. It doesn't exist anymore. That was an accelerated provision that a lot of owner-operators took advantage of. Okay? It allowed you to write off 50% of the qualifying property, which was 5-year property, kitchen equipment, seating and decor, and the like. Section 175, in 2013, that was $500,000 with a cap of $2 million. What that basically meant was that in 2013, you had Section 179 expensing provisions that allowed you to expense up to $500,000 worth of qualifying property. Again, 5-year property, with a limit or a cap of $2 million. Now, in 2014, those numbers have been reduced drastically. Now you have the opportunity to expense up to $25,000 with a cap of $200,000. What that means is through 179 expensing, you can expense up to $25,000 worth of qualifying property with a cap of $200,000, meaning if you purchased in any 1 year more than $200,000 of this 5-year qualifying property, which could easily be done through a major reinvestment project, a rebuild, or even in store purchase, you can only write off up to $25,000. Over $200,000, it's dollar for dollar. So, big changes. $500,000 to $25,000, and with bonus, 50% to 0%. So it's extremely important that you stay in touch with your tax advisor, especially as we move through the first quarter of 2014. Congress has not acted upon this as of yet. We're waiting to hear if, in fact, bonus will be reinstated, and if, in fact, Section 179 will be increased to some number other than $25,000. We will communicate to you as well if we hear anything, but as of right now, those provisions have been reduced and in some cases taken away. That has a major impact on your tax planning, because as you engage yourselves in some of these major reinvestment projects, you had the opportunity to accelerate depreciation to help offset taxable income. Now it's not going to be as easy. Again, we're watching to see what Congress does, but it's important to know that at this time, those are the limits and the levels of depreciation that you're allowed. Cost seg studies in 2014. We're encouraging all of our clients, especially with the new repair regulations, which I'll talk about next. We're encouraging all of our clients to get cost seg studies when they do major reinvestment projects. There are firms out there that specialize in McDonald's type work that understand what an MRP and a rebuild looks like. But the important part of a cost seg study is that it really identifies the asset classes that are being added with your project, with your major reinvestment project. And that's going to, in turn, help you to maximize the amount of depreciation you can take. Cost seg studies run anywhere from $1,200 to $1,800. It's really, really important. Talk to your tax advisors, but it's certainly something you want to consider. Now, repair regs. I'm not sure if you heard much about them, but it's an important regulation. It's extremely complex. However, I'm going to try to simplify it for you now. We could actually have an entire webinar on repair regs. We're not going to do that. But the principal things that you need to take from this is the difference between capitalizing versus expensing certain property. The general principles of capitalization versus expensing of any type of tangible property used in our McDonald's businesses, which is that 5-year property that I'm talking about, kitchen equipment, seating and decor, and that kind of stuff, has long depended on facts and circumstances to determine whether or not these expenditures maintain or restore property in or its ordinarily efficient operating condition. In that case, that would be something we would expense. If it appreciably prolongs its life, materially increases its value, or adapts it to a different use, then it would be something that we would capitalize. Under the final regulations, any expenditure must be capitalized if it results in a betterment, an adaptation, or a restoration of the property that we're talking about. A capitalized improvement to property is also now more precisely defined, mainly as expenditures that result in, as I said, a betterment, adapting the property to a new or different use, or restoring it to working order, or like new condition after the end of its depreciable class life. Basically what we're saying here is if we are pretty much restoring property to its ordinarily efficient operating condition, it's considered a repair. If we're extending its life or materially increasing its value, it would be considered something that we would capitalize. Now, there are de minimis rules associated with this, and there's a de minimis election that you need to make as McDonald's business owners. The de minimis election talks about two things. One is businesses that have audited financial statements versus businesses that have compiled financial statements. You have businesses, most of you have businesses that have compiled financials. I don't believe any of you have businesses that have audited financials. Because they are compiled, the threshold cannot exceed $500, meaning any type of expenses that you incur in that 5-year property range that exceed $500 must be capitalized. Now, what the new repair regs tell us, that is as of 1/1/14, as business owners, you need to have capitalization policy letters in place. We actually sent a sample letter to all of our clients that stated the $500 threshold, and we had our clients sign it. This is the de minimis election I was talking about that can be made annually, but at least it's a signed letter by you stating that you understand the repair regs and that you understand the threshold of $500 with regard to the new repair regs. Very, very important that you have this capitalization policy letter in place. If you don't, you should reach out to your CPA or your trusted advisor and ask them about a capitalization policy letter. If they don't know anything about it, you can reach out to me. I can certainly forward you a sample. But it is extremely important that you have at least, at a minimum, a capitalization policy letter in place to comply with the new repair regulations. As I said, somewhat complicated. If anybody has any questions, I can certainly take those offline and discuss them with you later. Other credits that we should consider. So these are other business type credits, employer credits. WOTC, very important. A lot of you have employees that qualify under work opportunity tax credits. Take full advantage of this. These can be huge credits. I mean, I've seen owner-operators with $25,000, $35,000, $45,000 worth of tax credits generated just from work opportunity tax credits. This is a tax credit. It reduces your tax dollar for dollar. Also, empowerment zone credits, huge. And you may not realize this, but your stores may be in and around an empowerment zone or a renewal community. There are major tax incentives if so. And it's not necessarily your store that needs to be in the empowerment zone, but it's the employees that live within the empowerment zone. Again, reach out to your tax advisors and your CPAs. If you have stores that are in major cities or secondary cities, believe it or not, you may actually have empowerment zone credits. I mean, I have clients in Oklahoma City, for instance. Not a huge city, but a city. And believe it or not, within that city, they have empowerment zones. So there's credits available to those owner-operators. So again, something you really need to look into. The other thing I have on this slide is S-Corp compensation. Reason why I bring this up is it's really a consideration that you need to make. And that is that if you have an S-Corp, you should be taking a salary on that S-Corp. The IRS is looking at S-Corp, 1120-S returns that don't have any salary reported on them. It's so important. If you have an S-Corporation, you should be taking compensation, officer's compensation. It usually shows up on the front of your return. But the reason why I have this here is that compensation must be reasonable. Okay, it must be reasonable. If you have any questions, again, reach out to your tax advisors. But if you don't have S-Corp compensation on your corporate tax returns, you need to talk to your tax advisors. That's an important consideration moving forward. How does my federal and state income taxes that I pay affect my financial viability? Again, I mentioned this earlier. This is an important one. Don't forget, tax rates have gone up. So the upper threshold, the upper limit, was raised from 35% to 39.6%. So there's definitely, if you're a business that has cash flow equal to or greater than last year, most likely your taxable income is going to be higher than it was in 2012, meaning you will be making more tax payments to cover 2013's tax liability. As I said earlier, anytime you pay federal and state taxes or you pay the balance due on your federal return, believe it or not, that amount of money comes out of your draw. And because your draw goes up, your draw increases, it's going to affect your cash flow coverage ratio. I have a slide here that talks about the cash flow coverage ratio, and we have slides like this for each one of the ratios, but this one specifically, as you will see, I've highlighted in red negative decreases. Increase in draw and distributions, believe it or not, has a negative effect on your cash flow coverage ratio. So if in fact in April you have a big tax payment due, that's going to come out of your draw, it will affect your cash flow coverage ratio. And it's important that you understand and realize that. Obviously there are other things that can affect that specific ratio, both positively and negatively, and they're listed here on that slide. But really, when you think about planning in general, it's important to consider the things that you do in your business and how they can affect your viability. It's more important than ever before. I can remember 25, 30 years ago, McDonald's was a P&L focused company. And it was really a P&L driven company. It was all about food costs, paper costs, labor, pace. Today it's changed. Today it's a balance sheet company. And it's a company that has certain ratios in place to ensure that your health as an owner-operator remains strong. So tax planning becomes vitally important, not only in forecasting future tax liabilities or deciding whether or not to do reinvestment projects this year or next year, but it's also vitally important in maintaining strong financial viability. That's all I have for today. I didn't want to take too much of your time, but those are our top 5 tax considerations. I do want to tell you this. This is very important. If, in fact, in 2013, you underwent some sort of a major reinvestment project, whether it was an MRP, a rebuild, a reload, it's very important that if you haven't filed your tax return as of yet, there still may be opportunities for you to have discussions with your tax advisor or your CPA relating to the amount of depreciation you're taking, whether or not you're accelerating it, whether or not you've maximized the amount of depreciation available, or whether or not it even makes sense to maximize the amount of depreciation available to you. What I'm saying there is you may have had a project this year, but you may have a bigger project that you're doing in 2014. So you may not want to take advantage of all your depreciation in 13. You may want to leave and set some aside for future years when taxable income will be exposed because it will have less and less depreciation. Versus the situation that I just mentioned. You have a big project coming down next year, then you may want to be a little bit more aggressive in 2013, take more depreciation because you'll have another opportunity in 14 to shelter taxable income. So these are all the different types of planning things that you should be engaged in, and that opportunity still exists if, like I said, you haven't filed your 2013 business tax return as of yet. You can still reopen that discussion and make any changes to depreciation you need that most benefits your organization from a tax point of view. At this point, I don't see any questions. So I am going to conclude. I want to thank everybody for their participation today in today's webinar. I hope you got something out of it. We do have another webinar scheduled in March, and I believe it's on the 18th, and it's the top 10 financial considerations for next-gen candidates. We're also going to be doing one in March as well, and more news to follow on that. If you're a 1- or 2-store or 3-store owner-operator, some of the issues facing smaller owner-operators and how to ride the storm through economic downturns like we're having today. So in any event, I want to thank you again. There's our contact information. You also have my email address. Please reach out to me if you have any questions. I thank you. Be well, and we look forward to seeing it worldwide. Thank you. Take care.